A very good morning to all. Today we will again continue on the topic of portfolio management. So we'll start with the question number 15 because till question number 14 I think we have done in our previous session. Perfect. So question number 15 is a very unique question, students, and I want all of you to please pay attention to this because this is somewhat different to the concepts that we have studied till now. Indra has a fund of rupees 3 lakhs which she wants to invest in the share market with rebalancing target. Now there is a new term introduced to us, rebalancing target. After every 10 days to start with, for a period of 1 month from now. Sorry. Hi Chale, good morning. Tanisha, Kusuma, Mansha, good morning. The present Nifty is 5326. The minimum Nifty within a month can be at most be 4793.4. She wants to know as to how she should rebalance her portfolio under the following situations according to the theory of constant proportion portfolio insurance. Good morning, Shruti Meghna. Using 2 as the multiplier immediately to start with and 10 days to start with after first being the day of rebalancing if Nifty falls to 5122. And 10 days further from the above date if the Nifty touches 535539. Okay. For the sake of simplicity, assume that the value of her equity component will change in tandem with that of the Nifty and the risk-free securities in which she is going to invest will have no beta. Let us first try to understand the facts that are given in the question. Sorry. Sorry. So students, presently the Nifty is how much? 5326. Then it will be 5122.96. Then 5539.04. And lastly, we are not given this. Okay. Now they are asking us that if the portfolio is moving in such a direct, if the Nifty is moving in such a direction and I have to invest a fund of rupees 3 lakh in such a way that I always rebalance my portfolio basis the risk that I'm going to undertake that is defined as 2, then what should be my strategy? That is what the question is asking us. Let us try to understand from the solution how we will be able to achieve this. Okay. So, first of all, students, we have been given that the minimum Nifty can go within a month can be at most 4793. What is the present Nifty? So, student, the present Nifty is 5326. And minimum Nifty can go up to 4793.40. Can we calculate what percentage tolerance is available? So, can we say that maximum decline in 1 month will be how much? 5326 minus 4793.40 divided by 5326. Okay, students. So minimum, yes, Tanisha, you're right. So minimum Nifty can go to 4793.40. Hence, the maximum decline that is tolerable in a particular month is only 10%. Okay. Now, for making a portfolio as per constant proportion portfolio insurance, what we need to do is we need to define this formula: multiplier multiplied by portfolio value minus floor value. So this will give us the value of equity that can be invested in a portfolio. Okay. Equity investment is equal to 2, because multiplier is 2, that is given in the question, which is this. Correct? 2 multiplied by what is the portfolio value currently? 3 lakhs minus. Now, what would be our floor value, students? Yes, Tanisha, you're right, 10%. What will be our floor value, students? If we again read out the question, what does it say is, Indra has a fund of rupees 3 lakh which he wants to invest in the share market with rebalancing after every 10 days to start with a period of 1 month from now. And the minimum Nifty also they have given. She wants to know how she should rebalance her portfolio under the following situations. So, if the tolerance that we have calculated about the maximum decline in 1 month at the rate of 10%, that means maximum the downside risks that the Indra would be able to take up is only 2,70,000. Okay. So this is how we have calculated this. This is actually 3 lakh into 1 minus 10%. Okay. So this gives us 2 into 30,000, which is equal to 60,000. Hence, the initial breakup of portfolio will be equity of 60,000. Okay, equity of 60,000 and risk-free securities of 2,40,000, in totality 3 lakhs. This is the portfolio that we have formed. Yes, Tanisha, you're right. 2,70,000 and 60. Okay. So this is the portfolio as on day 1. And while this equity, we will say that this equity is actually the Nifty equity that we are investing. Okay. Because that is what it is given in the question. So since the beta was 2, hence we are able to take a risk of up to 60,000 in case of the investments of the fund, despite of the fact that the maximum downside risks that we can face is only 10%, as per the Indra's facts that are given in the question. Okay. Now, second part. So immediately to start with is done. Okay. Then 10 days later being the first day of rebalancing if Nifty falls to 5122. So students, first of all, what do we mean by rebalancing? By rebalancing, we mean that we need to constantly change the proportion between equity and risk-free securities basis the latest prices that are going on in the market. Why? Because the overall tolerance limits or the overall amount that we are expecting changes with the changes in the prices. It never remains same. Okay. Let us see how. So what will happen on day 10th? Okay. On day 10th, good morning, Ambika. So the value of equity will be how much after 10 days? 60,000 is what we have invested. What was the Nifty operating on day one? 5326. What is Nifty operating now? 5122.96. So has the Nifty fallen? Yes. If the Nifty has fallen, then our equity value will also fall. Correct? So this is how much. Just a second, students. Yes, so this is how much? 60,000 into 5122.96 divided by 5326. So this is actually 57,713. Tanisha, just check once. It should reduce. The value should go down because the Nifty was at a level of 5326. Now the Nifty has come down to 5122.96. And hence, the overall value of equity has gone down. Till now, all of you are there with me, students. Is there any other thing or any other doubt in the mind? Please do let me know. Yes, Tanisha, now it is right. Then, if 57,713 is the value of equity, what is the value of risk-free investments? 2,40,000. These are going to remain same, right? What is the overall value now? 2,97,713. Now, students, just see the revised portfolio value after 10 days is this much. Now, the constant proportion portfolio insurance policy says that you will have to always maintain this equation while you want to invest in any equity form. So again, we will put on 10th day, we will again calculate investment in equity, which will be again multiplier portfolio value minus floor value. Okay. So this becomes 2. What is the revised portfolio value? 297,713 minus what was our initial floor value? 2,70,000. Students, we cannot change our floor value because it was given in the question that for the first month, the maximum decline expected is 10%, and hence our floor value is fixed as that for the entire month. Okay. Okay, Tanisha, no worries. Yes, Mansha, that is correct. Then, if we do this, what is the revised number of equity value? 55,426. And hence the risk free This is equity. The risk-free securities will be 297, 713 minus 55, 426. 242, 287. This is our revised portfolio after 10 days. Yes, Tanisha, the numbers are correct. Okay. Then what happened after another 10 days? So student, this is the 10th day. Now we are talking about the 20th day. Okay. Sorry. 20th day. Now what will be our revised value of equity? 55,426 was the opening value on 10th day. What was the Nifty value on 10th day? 5122.96. And what is the closing value after 20th day, which is 5539.04. Correct? So 55,426 on 10th day has become, because of these changes, how much? 59,928. This time, the value of equity has increased, students. Correct? The value of equity has increased because the value of Nifty itself has increased. And we are saying that in whichever way that Nifty will go, our portfolio also will move in the same direction. So Tanisha, yes, Tanisha is asking, could you please tell the reason as to why it is required to always calculate the investment in equity? Yes, because that is the real essence of constant proportion portfolio insurance. See, as per the facts that are given in the question, we have to do operations using this assumption. Okay. See, for the sake of simplicity, assume that the value of her equity component will change in tandem with that of the Nifty. So that means they are saying that it will change in the same way. The Nifty will change and the risk-free securities will have no beta. So you are getting the point. Okay. So in a way, whatever equity is she investing, that will move in the same direction in which Nifty is moving, and risk-free securities will have no beta. Now, to form a portfolio, we will have to recalculate the equity. Okay, that's what the, because if you continue with the 60,000 equity from day 1 to 10th and 10th to 20th, then the equation or the constant proportion portfolio insurance CPPI will not be maintained. Now, the value of equity is this, and the value of risk-free securities will be same again, 242, 287. Okay. The total becomes how much? 302, 215. So now this is the revised value of portfolio. Revised portfolio value is this much. Now further, again we will maintain the same equation. Revised investment in equity. Two multiplied by 302,215 minus 2,70,000, which becomes 64,430. And hence the revised portfolio looks like first equity is how much? 64,430, and balance will be your risk-free securities. Which will be how much? 302,215 minus 64,430. 237,785. Okay, students. So Tanisha is asking, how did the value of risk-free securities changes since they are the risk-free and don't carry any risk premium and beta factor? Yes, we are also saying that, Tanisha. We are not saying that it is changing because of the Nifty changes. We are saying that, okay, see, first of all, on day one, you started with this, correct? Now we are saying after day 10, initial portfolio is this and revised equity value is this. So the total amount drops to 297,713. Now, out of the 297,713, we again want 55,426 as equity, and balance, we will increase our risk-free securities investments from 242, 242, 287. So basically, we will increase it from 2,40,000 to 2,42,287 by selling some of the equity, because equity value was how much? 57,713, and now we only want 55,426. Correct. So we will sell off the equity and we will invest in risk-free securities. Now in the second step, on the 20th day, we will invest in equity and we will reduce our risk-free securities. Our risk-free securities was how much? 242. Now, as per the revised proportion, it is 237. Okay, so both on day 10th, it is investing more in risk-free securities. Day 20th, it is investing more in equity. Yes, Mancha, you are right. On 20th, value of equity is increasing. Yes. So the risk-free securities are not changing, only the value of portfolio is changing. Basis that we are changing our components. Okay, students. I hope this is clear. Can we move to the next question then? Question number 16, students. Following information is available regarding expected return, standard deviation, and beta of 6 shares are available in the stock market. So they have given us six securities, and for those six securities, whatever is their expected return beta and standard deviation, they have given us. Suppose the risk-free rate of return is 4% and market return is 6% and standard deviation is 10%. You are required to compute. So this standard deviation, students, they have given for market. Okay. This standard deviation they have given for stocks. Standard deviation for stocks respectively, as per their own betas, right? And expected return is expected return. We are required to compute which security is undervalued and which security is overvalued. This is an easier one. So whenever the question talks about undervaluation or overvaluation, we have to calculate the CAPM related expected return, and whatever that security is giving these returns, we have to compare it with them. Okay. So solution wise, using capital asset pricing model, return of a security is equal to RF plus beta RM minus RF. Correct? Security 1, 2, 3, 4, 5, and 6. Six securities are there. Required rate. What is the risk-free rate, students? 4%. Then we have the beta. For first security, beta is 0.7. Then market rate is 6% minus risk-free rate is again 4%. Then for the next one, okay, let us find out the value first. 0.7 into 2, 1.4, 1.4 or 1.4 and 4 is 5.4 percentage. Okay. Then comes the second security. This is 6.10%. Then the next one is 4% plus 0.95, 6% minus 4%, which is equal to 5.90 percentage. Okay, students. Then for the fourth security, 4% plus 1.10. This becomes how much? 6.20. Then for the fifth security, 4% plus 1.40, 6 minus 4 again. In terms of percentage, it comes as 6.80%. Then next is 4% plus 1.7, 6 minus 4, which is again 7.40 percentage. Okay. Then expected return that is given in the question. 5, 10, 11, 12.5, 15, and 16. And then status. Status we will tell now whether it is overvalued or undervalued. So students, as per CAPM, we are supposed to get 5.4 percentage, but market is giving us 5 percentage. So what should we do? Yes, Kusuma and Tanisha, very good. Thanks for answering. Mansha, if CAPM return is less than actual return in market, overvalued sell and vice versa. No, Mansha. Just check what you have written, Mansha, once. I think that is exactly the opposite. So that's what I'm asking now. Let all of you revert. Market is giving us 5%. However, my expectation is 5.4%. How my expectation is derived? Because of CAPM. If I am undertaking a beta of 0.70 and the market conditions are holding good, I should at least earn 5.4. But market is giving 5% on that stock. So what should I do? Shailesh, Kusuma, Tanisha, just think again. Don't you think I'm getting a lower return from market? See, students, this expected return, you assume that in market, this is the return that is going on. And this is what the calculated return is. My my calculated return says that I should at least get 5.4. Then only this beta, this risk-free rate and market rate of return makes sense. Yes, it is Jensen's alpha, Tanisha. Yes. So the status here is that it is overvalued. And I will sell this. Okay. Now, similarly, market is giving me 10. However, my requirement is only 6.10. Don't you think market is giving me extra? Hence, it is undervalued. Or I can say I will purchase it. Similarly, here also I will purchase it. 6.2, 12.5. Market is giving me 12.5. My expectation is only 6.5. I will purchase it. 6.8, 15. I will again purchase it. 7.4 and 16. I will again purchase it because here also the expectation is only 7.4, but the actual return that I'm getting is 16. Yes, Mansha, you are right. Now, Tanisha is saying we must not invest or sell the security. Please correct. No, Tanisha, we should. See, in the first case, we should sell the security if we have, because our expectations are not getting met. The rest, in all the cases, we should purchase. Okay. Yes, Tanisha, overvalued we have to sell, undervalued we have to purchase. Okay. Undervalued we have to buy, overvalued this. But sir, isn't the case stock will rise in future because intrinsic value of stock? No, Mansha, I request please don't go to the intrinsic value concept as of now. Just stay on these percentage returns. Okay. Because intrinsic value have different meanings in different context. So just think that as per the calculation of CAPM, the expectation is as per this column, which is 5.4, 6.10, 5.9, 6.20, right? The market is giving you on the next column, which is that percentage is 5, 10, 11, 12.5. So just compare these two, okay? So this is done. Securities is undervalued and which is overvalued. This we have specified. Undervaluation for these ones for all the 2 to 6 and overvalued for 1. So can we say that because their required rate of return is less than expected return? Simple. The required rate of return is given by CAPM. Then security 1 is overvalued because expected return is less than required rate of return. Okay. This part is clear, students? Yes. So let's go to the next part. Assuming that funds are equally invested in these 6 stocks, compute return of the portfolio and risk of the portfolio. Easy. They're asking us that 60%, sorry, 161616, we will invest in all these 6 stocks. You have to compute the return and risk. Easy. So let's do that. So this is second part, calculation of portfolio return and risk. Portfolio return will be given with a simple sense of 1 by 6 into their expected returns that are given in the market, which is 5, 10, 15, 11, 12.5, 15, and 16. We will not use our CAPM returns, okay? Because those are based on betas. We will actually see what is going into the market and calculate the portfolio return basis that. What are the values? First of all, 5, then 10, 11, 12.5, 15, and then 16. So one security, 1, 2, 3, 4, 5, 6, like that, we have put in here. Okay, if we add it all after taking the weighted beta, sorry, weighted portfolio return, the portfolio return comes out to be 11.58 percentage. Okay. Yes, Tanisha, your answer is correct. Then, for the next step of calculating the overall portfolio risk. So students, we will be using the Sharps index model here because we have been given beta and we have also been given the market standard deviation. Correct, students? So we are not using Markowitz portfolio theory. We will be using Sharps index model. So yes, for that portfolio risk, we first need to calculate what is the portfolio beta. Portfolio beta is given as 0.70 into 1 by 6 plus 1.05 into 1 by 6 plus 0.95 into 1 by 6 plus 1.10 into 1 by 6 plus 1.4 into 1 by 6 plus 1.7 into 1 divided by 6. So which is equal to 1.15. Portfolio beta is how much? 1.15. Okay, students. Then we understand that portfolio variance is equal to weighted beta square, correct? Multiplied by standard deviation of market square plus weight square into residual variance. Wherein we say that we take a summation of I is equal to 1 to n for all the observations. 1 to n. This is what the formula was as per the Sharps index model, students. I hope this is clear. Till now, all of you are there with me, students. Please let me know. Yes, Tanisha, your answer is correct. Very good, Tanisha. Now, first of all, we have to calculate this residual variance because what we have been given in question is the overall number, right? So stocks 1, 2, 3, 4, 5, and then 6. Okay. What is their total variance? Total variance is the square of what has been given as standard deviation. So they have given us 9 here, 9 percentage, right? So 9 percentage into 9 percentage will be 0.0081. Okay. Then the next one will be 0.0196. Then the next one will be 0.0144, 0.04, 0.03, 0625. 0.0625. Okay, this is the total variance, students. Then systematic risk for the individual securities we have to compute to arrive at the unsystematic risk. And as I told you, students, whenever we have to add or reduce any risk related number, we always do it on a variance level. Then we do a square root to arrive at the standard deviation, correct? So hence we have plotted variance first. Now the systematic risk will be in variance level again. So beta square multiplied by standard deviation of market square, correct? 0.0049. Then 1.05 square, okay? 0.10 square. Okay, students? 0.011025. Then 0.95 square, 0.10 square again, which is 0.009025. Then for the fourth security, 1.1 square, 0.1 square is equal to 0.0121. For the fifth security, 1.40 square, 0.10 square is equal to 0.0196. For the last security, 1.70 square, 0.10 square is equal to 0.0289. Now, unsystematic risk will be calculated as this is, let's say, A and this is B. So this will be A minus B. Okay. Total variance minus systematic risk. So this becomes 0.0032, 0.008575, 0.005375, 0.0279, 0.011025, 0.0336. Okay. I hope we are sorry. No, Tanisha, we have not considered the weights of securities till now. Sorry. Now we will consider the weights of securities. Weight square into residual variance square. Okay. So residual variance square is already here. So in this, we will multiply by 1 by 6 into 1 by 6 two times, right? Because we will have to do a weight square here. Okay. So this is how much? 0.00009, 0.00024, 0.00015, 0.00077, 0.00031 and 0.00093. So students, again, I'm telling how we have computed the last column. The last column is computed by taking the unsystematic risk and dividing it by 6, again dividing it by 6. Okay. I'm just putting a sample calculation here, 0.0032 into 1 by 6 into 1 by 6. Because weights have to be taken as a square. That's why. I hope this is clear. 0.10 Mansha is actually the uh, market risk that is given in the question. This is beta square into standard deviation of market square. This is the formula for systematic risk. That's what we have used. Okay, then next. Next, now let us calculate the portfolio. Systematic risk. Okay, first of all, sorry students, we have to actually calculate the portfolio unsystematic risk by taking a total here. 0.00249. This is clear. First part is clear. Then let's go to portfolio systematic risk. Portfolio systematic risk will be beta square of portfolio. What is the portfolio beta? 1.15. And standard deviation of market square. Correct? Sorry. So this comes as 0.013225. So 1.15 into 1.15 into 0.10 into 0.10. Okay. Now, overall portfolio risk will be, so this is in the form of standard deviation. Okay. We will take a square 0.013225 plus 0.00249. Okay. So this comes as how much? 0.0249 and taking a square root. So the standard deviation of portfolio is 0.1253. So this is the risk of portfolio. Or we can say 12.53% because in question, the problem is given in the form of percentage. Okay. Yes, Tanisha, both of your queries are right. So in first part, Tanisha is saying why we have done 1.6 into 1.62 times. Why? Because the weight has to be multiplied in the form of a square. So weight one square means 1 by 6 into 1 by 6, two times you will have to multiply. Why did we take the assumption of column B to get the total systematic risk? No, we cannot take the total systematic risk like that. We first have to calculate the beta, portfolio beta. And then basis that portfolio beta, we will have to arrive at the overall systematic risk. Okay. I hope we are clear till here. Or else, Tanisha, to your question, we could have taken a total here, but first we need to multiply it with the weight square. So if we multiply 0.0049 into 1 by 6 into 1 by 6, and similarly for all these observations, then we can take a square, then we can take a summation there. Okay, then also the answer will be same. Okay. So students, let's come to the last part of this question. Suppose if the above portfolio is invested in with a margin of 40% and the cost of borrowing is 4%, then what will be the position? So what they're trying to say in the third part is you have this portfolio. Let's say you have this portfolio at the rate of 1. Okay. What we are doing is we have taken a borrowing of 40%. Okay. So that your portfolio becomes 1.4 and the borrowings is minus 0.4. So as to arrive at 1. And the borrowing that they have taken is at the rate of 4%. Okay. Now, in this case, expected return students will be how much? 1.4 is the portfolio weight multiplied by the portfolio return. What was the portfolio return? We just now calculated above. 11.58. Plus. Now, the weight of borrowing is how much? Minus 0.40 into what is the cost of borrowing? 4%. Okay. So how much expected return we will get? 11.58 multiplied by 1.4. 0.4 into 1.4. No, sorry. 0.4. So this comes as in totality 14.612. Correct, students? This is the expected return. Now let's come to the risk part. Borrowings. Do borrowings have risks? No, right? Borrowings is not having any kind of a risk. So the impact at last will be 1.4 times of the portfolio of return. Okay, let me just put it in the revised scenario, which is we will calculate the overall risk. We will just simply say weight of portfolio standard deviation. Correct? Weight of portfolio multiplied by standard deviation. And we can also do weight of borrowing, but which will be again 0. So hence we are not taking that. So 1.4 into what was the portfolio standard deviation? 12.53. So this comes as 1.4 into 12.53 is 17.542 percentage. This is the risk of the portfolio. If you take a 40% borrowing and invest in portfolio, then your risk will go above, right? With your risk will go high. Okay, students, I hope this is clear. Let us come to question number 17, students. An investor holds two stocks, stocks A and B, and analyst prepared X and probability distribution for the possible economic scenarios and the potential returns for the two stocks and the market index, which is shown as below. So they have given us three scenarios. Probabilities are given, the returns are given, and the market return is also given. The risk-free rate during the next year is expected to be around 11%. Determine whether the investor should liquidate his holdings in stock A and or B, or on the contrary, make fresh investments in them. CAPM assumptions are holding true. Okay. Now, since they're talking about CAPM, and we are also supposed to tell them whether they should liquidate his holdings or not, which is a decision on buy, hold, or sell, correct? Which comes from Jensen's alpha. For Jensen's alpha, we need to take use of CAPM. For CAPM, we need to have beta. And return from market. Risk-free is already there, which is 11%, correct? So we have to first calculate return from market and beta. Then only we will be able to arrive at expected return as per CAPM. Then only we will be able to tell whether the actual return minus expected return is what it is giving us the better returns or not. Okay. So first of all, students, let's first calculate beta. Okay. For calculating beta, we need to calculate covariance. And before calculating covariance, we need to have the mean return. So let's first calculate the expected return on stock A. So simple, probability multiplied by the return, which is 0.40 multiplied by 25% plus 0.30 into 10% plus 0.30 minus 5 percentage. So this brings us 11.5% on stock A. Similarly, on stock B will be again 0.40 into 20% plus 0.30 into 13% plus 0.30 into minus 3, which gives us 10.2 percentage. Then variance of, sorry, we will have to again calculate the market returns. Market returns are 0.40 into 18%. Then second one, for 30% probability, there is a return of, I think I have written something wrong. Just a second. Wait, students. So for B, it is 0.4 into 20%, 0.3 into 15%, then again 0.3 into -8, which is actually 10.1 percentage. For market, 0.4 into 18%, 0.3 into 13%, and then finally 0.3 into -3, which is actually giving 10.2 percentage. Yes, Tanisha. Thanks for that. I have corrected it. Then we will have to calculate. So for calculating beta, we can use covariance divided by variance, covariance of stock A and market, and variance of market. This will help us in calculating beta of A. Correct? So students, in this case, we will calculate first the market variance. Okay. How we can calculate the market variance? Expected market return is 10.2. So we will have to just calculate the deviation, take a square, multiply with the probability square. Plus 13 minus 10.2 square into 0.30, minus 3 minus 10.2 square, 0.30. Okay, so this comes as 24.34 plus 2.35 plus 52.27, which in totality becomes 78.96 percentage. So the variance of market is coming as 78.96 percentage. Now let's calculate the covariance between stock A and market. Covariance between A and market. Okay. So for that, we will have to calculate the joint covariance, right? So 11.5 was the A's return, right? What was the first value return? 25 minus 11.5. And for market, the first return was 18 minus 10.2, which is also evident from here. Correct? And that we will take the probability. Then similarly for the second observations, 10 minus 11.5, 13 minus 10.2, and probability 0.30. Then lastly, the third one is minus 5 minus 11.5, minus 3 minus 10.2 into probability of 30%. So this brings us to 106.2. So the covariance between A and M, A stock and market is 106.2. Similarly, covariance between B and M, okay, B and market is 20 minus 10.1, 18 minus 10.2, 0.40 plus. The second observation for B was 15 minus 10.1. Market is giving us in the second observation how much? 13 minus 10.2. And the probability of the second observation is 30%. The third observation, B is giving us minus 8 minus 10.1. And market is giving us minus 3 minus 10.2 with a probability of 30%. So hence the total covariance for B and M is 106.68. Not very far from what A is, right? Okay, students. I hope till now it is clear. Then beta for A will be covariance between A and market divided by variance of market, which is actually equal to 106.20 divided by 78.96, which is 1.345. So the beta for stock A is 1.345. Beta for B, covariance between B and market divided by variance of market, which is actually given by 106.68 divided by 78.96, which is equal to 1.351. Now, stocks CAPM and then expected, sorry, expected return. Stocks A and B. What is the risk-free rate of return? 11%. What is the beta for A? 1.345. Sorry, market return is how much, students? 10.2 minus 11. So market return is even lesser than the risk-free securities, right? Similarly, for B, it is 1.351 is the beta, 10.2 minus 11. So the CAPM return for stock A is how much? For stock A is 9.924. And for stock B is 9.92. That's all. And hence, just a second, friends. ठीक है. So it's 9.92. Perfect. Then whatever is their expected return, 11.5 for this and 10.1 for stock B. So market is giving you 11.5. Your calculation is saying you should have at least 9.924. What will you do? They both are underpriced. And hence they should be purchased. Same. So what we are concluding here, since stock A and B, if you calculate their alpha, Jensen's alpha, right? It will be difference of both of them. Have lower required rate of return as per CAPM. Since stock A and B have lower required of rate of return as per CAPM when compared to the expected return, hence the investor should make fresh investments. Okay, students? Okay. Yes. So, Tanisha, we don't need to calculate the beta market because beta for market is always 1. Because what will you do? Variance, covariance of market divided by variance of market, which is always be equal to 1. Okay, students? Okay, so let's take a break of 10 minutes, students. It's 8:15. Let's again reconvene at 8:25. Uh, till now, we have covered almost all the questions. Now, the last question that we are going to do is about a concept that the last concept that is missing for us till now, which we will cover through this question. So, students, if you see in our entire portfolio, management, we have studied different models, different ways to evaluate a portfolio, different ways to evaluate a security, and even how to interpret, let's say, in different business scenarios, the situations that we were given to us in the previous question. But in this specific question, why this is so important is that in this we are going to construct a portfolio. Okay, with some of the inputs that are given to us, we have to arrive at that out of these six securities. First of all, which securities has to be picked, and once that security is picked, what proportion of investment we have to do in that security. Okay. So this is a single unique question that is there. We will cover that. So this actually is also part of the, this also is part of our portfolio management. Okay. Now let's try. So the facts are very simple. They are telling us Ramesh wants to invest in a stock market. He has got the following information about the individual securities. Security A, B, C, D, E, and F. There are six securities that are given to us with some of their observable, market inputs, which is, let's say, expected return 15, 12, 10, 0, 9, 8, and 14. These are the expected returns. And we have been given their betas respectively. Plus, we have been given a standard deviation of 40, 20, 30, 20, 10, 20, and 30 as well. Market index variance is 10% and the risk-free rate of return is 7%. So they are telling us that the market index variance, which is the risk of market, is 10% and balance is 7%. What should be the optimum portfolio, assuming no short sales? See, they have also told us that there is no short sales allowed. Short sales is short position that we discussed yesterday in our previous session. We said that short position is not allowed here. You have to just think it from the investment point of view, from the long position point of view. Okay. So it is a very sequential step based, model that tells us which security and what proportion in that security. So we will follow that. Okay. Solution. So students, first of all, it says that you have to calculate the Trenner's ratio for each security. The first step is calculate Trenner's ratio for each security. Calculation of excess return to beta. Correct? Excess return to beta is Trenner's ratio. What is Sharpe's ratio? Excess return to standard deviation. Correct? So let's put all the stocks here. Security return, let's say A, B, C, D, E, and F. These are the six securities that are being given. Their returns are 15, 12, 10, 9, 8, and 14. These are their returns that are given. What is their beta? Beta is 1.5, 2, 2.5, 1, 1.2, and 1.5. Okay, students. Till now, we have just put whatever is there in the question. Okay, then next one is calculation of excess return. RI minus RF. So 15 minus 7, 8, right? 7 is the risk-free rate of return, which is specified in the question. So 15 minus 7, 8, 12 minus 7, 5, 10 minus 7, 3, 9 minus 7, 2, 1, and 14 minus 7, 7. Okay. Then we have to calculate the Turner's ratio by dividing it by beta. Correct. So 8 divided by 1.5 is 5.33. Then 5 divided by 2, 2.5. 3 divided by 2.5, 1.2. 2 divided by 1 is 2. 1 divided by 1.2 is 0.83. And 7 divided by 1.5 is 4.67. So students, I hope till here all of you are there with me. Okay. So this is a very step-by-step process. First step is to calculate the Turner's ratio. And now we have to rank basis the Turner's ratio. Whichever security has the highest Turner's ratio will be ranked 1. Then subsequently lower ones will be ranked 2, 3, 4, 5 like that. And the lowest one will be the last rank. Okay. So the first rank here is actually, okay, 5.33 is the biggest one, right? So this is the first rank. Then the next bigger number is next higher number is 4.67. Then 2.5. Then this is the fourth rank. Then this is the fifth rank. And then this is the sixth rank. Okay. Perfect. So we have ranked basis the highest to lowest. Now in the next table, we will rearrange basis the ranks. We will take the first security having the first rank in the first line item, second rank in the second line item. Sorry. So security. So first of all, A is the security which is there in the first rank. Then second security is F. Third is B. Then fourth security is D. Then I think C. Sorry. Yeah, then I think C and lastly E. Correct? Students, please let me know till now. Is everything okay? Are you all clear? Mancha is saying, sir, for D, risk premium is 1 and for E, no, Mancha, please check again. 9 and 8. Yes, so 9 minus 7 is 2 only and 9 minus 8 is 1 only. Okay. So this is the security. Now, we have ranked basis standard ratio, rearranged basis those ranks. The next step is we will again put RI minus RF, which was 8, 7, 5, 2, 1, and 7. No, sorry. Actually, we have to put in the rearranged format. Sorry, students. So for A, we have to put the RI minus RF. Okay, students. So A, RI minus RF was 8. For F, RI minus RF was 7. For B, RI minus RF was 5. Okay, so this is actually a very common mistake. So please do remember, once you have rearranged it, RI minus RF has also be in the rearranged manner. 875. Then D. D, RI minus RF is actually 2. For C, it is 3. And lastly, E, it is, I think, 1. 8, 7, 5, 2, 3, 1. Okay. Then beta. Now, beta also we have to put for that respective security. 1.5, 1.5, 2, 1. 2.5 is for C, and for E, it is 1.2. Then residual variance that was given in the question, that also we will rearrange and put. That is how much? 40, 30, 20, 10, then again 30 and 20 for E. Okay, students. I hope this is also clear. Now the next step is, students, we have to calculate Ri minus Rf into beta divided by the residual variance. This is again a very evolved kind of a step. Hence, we will have to follow this. Okay, so just remember the next step is Ri minus Rf into beta I divided by residual variance. Okay, so 8 into 1.5 divided by 40. Which is 0.3. Then 5, sorry, I have to put 0.3 above. 7 into 1.5. 7 into 1.5 divided by 30, which is 0.35. Okay, students. Then 5 into 2 divided by 20, 0.5. This is for B. Then for D, 2 into 1 divided by 10, 0.20. Then next one, 3 into 2.5 divided by 30 is 0.25. Then 1 into 1.2 divided by 20 is 0.06. Okay. I hope this is clear till now. So in this step, we have just calculated the excess return into beta divided by the variance. Okay. Then what we'll have to do next? The next one is to rearrange this. Sorry, to take a total, to take a cumulative total of this column. This column, we will take a cumulative summation. Okay, so first one will be 0.30. Next one will be 0.30 plus 0.35 is equal to 0.65. Then 0.65 plus zero point 0.5 is equal to 1.15. Okay, students, I hope you're able to get it. So this is the cumulative column. Then 1.15 plus 0.20, 1.35, 1.35 plus 0.25, 1.60 plus 0.6 is 1.66. We have got the cumulative numbers here. Okay. So this is calculated. Now there is another calculation that we have to do. Okay, first you guys just see this. All of you students, please see this. If there is any question till now, do let me know. Then we will take the next step ahead. Yes, perfect. So there is no question till now, students. Now the next step is to calculate one more value and hence its cumulative numbers also. Now again, security. Again, we have to put in the rearranged form only. AF. The next one was B. The next one was D, C, and E. Correct? These were the securities. Now we have to actually calculate the beta and standard deviation square. These were the details that we were given. I'm just copying it again. 1.5, 1.5, 2.1, 2.5, and 1.2. Correct? These were the betas that were given. And the residual variance was 40, 30, 20, 40, 30, 20, 10, 30, and 20. Okay, students. Now, the next step is we have to calculate beta squared divided by residual variance square. This we have to calculate, which is 1.5 into 1.5 divided by 40. 0.056. Okay, then next one is 1.5 divided by 30 into 1.5. So square of beta divided by the variance. So 0.075. Then this one is 2 into 2 divided by 20. So 4 divided by 20 is 0.2. Then 1 divided by 10 will be 0.10. Then 0.208 and lastly 0.072. Okay. So this calculation is also clear. Now we have to take a cumulative for this column as well. Okay. Again, so first value will be 0.056. Then second will be addition of these two. 0.056 plus 0.075, which is 0.131. Okay, students. Then plus 0.2, it becomes 0.331. Plus 0.10, it becomes 0.431. Plus 0.208 becomes 0.639. Plus 0.072 becomes 0.711. Okay. So we have a cumulative of beta square divided by standard deviation. I mean the residual variance square. Okay. This is the cumulative column for this. Now we have cumulative of this, which is excess return into beta divided by standard deviation square. And below we have cumulative of this, which is beta square divided by the standard deviation of residual variance. Correct. Now we have to calculate the value of C. Calculation of C value. Okay. So C value for A will be calculated as 10 into the cumulative value of first table, which is 0.30. Okay. Divided by 1 plus 10 into cumulative value of second table for A, which is 0.056. So this becomes 1.923. Then C value for F. Our next security was F, right? So 10 into cumulative value for the first table Students, please note, we will not be taking this value. We will be taking this value, the cumulative values, okay? So 10 into 0.65 divided by 1 plus 10 into 0.131, 2.814. So C is again a variable kind of a number, Tanisha. Okay, we have just given it a nomenclature as C, that's all. Okay. Then for next securities after A, F, the next security is B. For B now, the cumulative value from the first table in front of B, which is 1.15, and divided by 1 plus 10 into, from the second table in front of B is 0.331. 2.668. 3D, correct? 10 into 1.35 divided by 1 plus 10 into 0.431. 2.542. Then for CC, it will be 10 into 1.60 divided by 1 plus 10 into 0.639. So which is equal to 2.165. Then CE is equal to 10 into 1.66 divided by 1 plus 10 into 0.711111, 2.047. So with this, we have calculated all the C value for all the securities, right? Sorry. Students, any other doubt till now? Let me again repeat what we have done till now. So first of all, we have calculated the Trenner's ratio, okay, which is excess return to beta for all the securities put together. Then we have ranked them. Highest Trenner ratio will get the first rank. Then basis those rankings, we have prepared a reorganized table. First rank first, second rank second, and then we have calculated two different variables, which is this and this, the below one, and hence calculated the cumulative value. Then we have arrived at the C value. Okay. Now, next part, we will have to find out the highest C value here. Which one is the highest C value, students? This one, correct? So the highest C value becomes our cutoff point. Cutoff point is 2.814, which is again at a security level of F. So wherever is the cutoff point, we have to take all the securities above that for our portfolio. Sorry. So cutoff point is this. Hence, sorry, security A and F will be selected. So till now, we have been able to say two securities will be selected, A and F, because the cutoff point is at F. So all the securities above that will be selected. Okay. Now, students, we have to calculate the Z values. Now, using Z values, we will be able to derive the proportion of investments. Sorry. See, now Z value is given by beta divided by variance of residual excess beta, sorry, excess return over risk free divided by beta into, sorry, not into, minus C. This is one bracket and this is another bracket. So simple, students. Now here the value of Z will be, for A first we will calculate, okay? Because Z now we will be only calculating for the two selected securities, which is A and F, okay? So for A, the Z value is 1.5 is beta, correct? Divided by 40 of residual variance. Ri minus Rf divided by beta, we have done in one of our above tables already, right? This one, 5.33. 5.33 minus, what is the C value of A? Not for A, sorry. The highest C value is 2.814. So students, please note that here C value we will be taking for cutoff point. Always, right? So it will be 2.814. So the total here is 0.09435. This is the Z value of A, students. The Z value of F will be, what is the beta of F? Beta of F is 1.5 and the excess return over beta was 4.67. 1.5, 4.67 minus 2.814, and the residual variance of F was how much? Was 30 actually. Okay. I hope this is clear. 1.5 divided by 30 into 4.67 minus 2.814, which is again 2.814 will remain constant with whatever securities we might have had So this brings us to 0.0928. Now we have the Z values. So these Z values are the weights. Okay. For calculating weights, we will use ZA. Weight of A will be ZA divided by ZA plus ZF. Similarly, weight of F will be equal to ZF divided by ZA plus ZF, which in fact is equal to 0.09435 divided by 0.09435 plus 0.0928, 0.0928 divided by 0.09435 plus 0.0928. Simple. Okay, students. So hence, weight of A, if we solve this, comes as 50.41%. And weight of B, sorry, F, not B, but F, because the security is F, comes as 49.59%. Sure, Tanisha, I will do that. Hence, finally, we have that funds to be invested in security A and F are 50.41% and 49.59% respectively. So first absorb this, then I will take all of you through this question again so as to tell you that what is the real thing that we are going to solve from this. Okay. Okay. Now hear me out, students. See, first of all, in any portfolio management, okay, we are actually trying to solve for certain questions. What are they? See, first of all, which security? Second is what proportion of funds? Third question is once that portfolio is formed, then whether is there any rebalancing required? And fourth question is how can we evaluate a portfolio? Okay. These are the broad four questions that we are trying to answer. So students, first of all, which security and what proportion is actually answered by question number 18 that we just now did. Because in real life, let's say you have been given thousands of securities. Now you will not know how out of those thousands of securities, which securities you will have to pick and what proportion you will have to invest to arrive at a very optimum portfolio. So this is actually called as the Sharpe's optimum portfolio. This process that we did is called as a Sharpe's optimum portfolio. Now, what is that process, students? See, process is very simple and easy. It's just a step-by-step thing that we have to remember. So first of all, students, we will have to arrive at the excess return to beta, which we call it as a Trenor's ratio, correct? Which is called as a Trenor's ratio. So excess return is return of security minus risk-free rate of return divided by beta. Then wherever is the Trenor ratio highest, don't you think we should pick them first? That is what the logic is. You rank them, first one being the highest Trenor ratio, because for 1 unit of beta, you are getting the highest excess return. That is the understanding. Then once you rearrange them, basis the highest rank to the lowest rank, then you calculate certain parameters. What are they? Excess return into beta divided by the residual variance. Okay. And then you find out that the cumulative wise, what is the number coming out to be? Similarly, there is another parameter to be calculated, which is beta square divided by the residual variance, and hence the cumulative amount of that. Now, these two cumulative columns goes as an input in a calculation of another variable called C value. This C value will help us in telling that what is the cutoff point, the maximum cutoff we will have to take till which security, whichever is the highest one in the C value, which will give us the highest value. Now, basis that cutoff, at least we are clear in our mind, whatever securities are above that cutoff needs to be selected. So those securities will be selected. Now, when those securities are selected, we also have to answer what amount of investments we have to do in them. That will be answered through the help of Z value. So for Z value also, we are using Trenor ratio minus C. Correct. If you see this in the brackets, Trenor ratio minus C is what it is. And lastly, we reduce C from that and multiply beta divided by the residual variance. Okay. Then we arrive at Z values. So Z values are the amounts of investment that we can expect. If these are the amounts, then to carry out the weights, we will just have to take those Z values and the total Z values to arrive at what proportion we are talking about in the overall numbers. Okay. So I hope this part is clear that we have answered from question number 18. Question number 15, I think, was on the rebalancing. Let me just check. Yes, question number 15 was on rebalancing, because generally what happens, an investor or a person who has invested the funds in a portfolio, they will not keep, let's say, they will not keep, let it go, whatever is happening, right? So they will do some active buying and selling in that portfolio to make sure that the entire objectives of the portfolio are met. That is where rebalancing is done. And the specific case that we have studied today is on the constant proportion portfolio insurance, CPPI, that we call it as. Okay. And evaluation of a portfolio studied. But in this, I tend to include three things. One is the Sharpe's ratio. Second one is the Trenor's ratio. And third one is actually the Jensen's alpha. Okay. And the overarching principle here is what is the risk? What is the return? Correct. Even for portfolio, even for security. For portfolio, there are two ways, Markowitz and Sharpe's index model. Students, any other question till now? Otherwise, there is one last topic that is left. I will cover that. And then mostly we will be done with the portfolio. Please do post in case any other questions are there, students. Okay, I think no further questions are there. So let me take up the last topic, which is the arbitrage pricing theory, which we also call it as APT. So we will not attempt any question on this, but I will just tell you what is the broad meaning here. Yes. So students, in capital asset, okay, let me just add some of the pages. So students, in capital asset pricing model, we use a variable called beta. Correct. Now the relevance of beta is that it relates the changes in a security to the changes in the market. Changes in security return in relation to changes in market return. So in all our minds, it is very clear that beta is used for relating the changes in security return with the market return. So I just want all of you to emphasize on this. However, what if there are other parameters other than return that can be linked to the market parameters and that security parameters? Okay. For example, GDP. For example, inflation. For example, exchange rates. For example, any other macro factor which is there published as a market. For example, even population for that matter. Okay, so we can actually relate the changes in a security return with the changes in all these parameters. Not only market return, but in all these parameters. Okay, for example, GDP, inflation. Okay, students. So let's say we're talking about company X. So it says that company X is having a beta of 1.5 on GDP. Sorry. So if the GDP increases or decreases by 1, so the company X's returns will also increase or decrease by 1.5. Okay. it will also increase or decrease by 1.5. Similarly, if inflation increases or decreases by 1, the company X returns will increase or decrease by 2. Why? Because the beta here represents the changes in a company's return with reference to the changes in GDP. And similarly, in the second place for inflation, it denotes the beta of 2 denotes the changes in company's return with reference to the changes in inflation. Okay. So the arbitrage pricing theory, it suggests that a return of a security is not only a function of market return and market related beta. It is also a function of all other factors that appears in the economy, for example, GDP, inflation, and other things. Now, the formula that they have given in arbitrage pricing theory is return of a security will be equal to risk-free rate of return, correct? That is there any which way is part of the CAPM. So why do we take risk-free rate of return? Because in case, let's say everything vanishes from the market, still risk-free rate of return will be there at least in the market. Or if the market actually goes to 0 and the beta is also 1, 1.5 or zero point 0.5, whatever it is, it will also go to 0. However, risk-free rate of return is the minimum amount that we can expect from that market. Okay. Plus alpha 1, beta 1, alpha 2, beta 2, like that, alpha 3, alpha n till beta n. So student, this is the formula given for arbitrage pricing theory. Now here, RF is equal to risk-free rate of return. Then this sign is actually the premium on account of that respective factor. So students, please note that in CAPM, what is the premium referred to? In CAPM, what is the premium referred to? Premium is referred to actually the market return premium, right? In arbitrage pricing theory, the premiums are mostly referred to the respective factors related premium. Okay, just as I given an example for GDP or inflation, whatever is the premium, that will come as a that respective factor premium. Then beta 1 is actually the beta measure of the entire beta measure of the respective factor. And we can also say that this is a sensitivity of a security to that factor. Okay. So this is the concept on arbitrage pricing theory. It actually says that sensitivity of a security can be related to any factor, not only market return, but to any factor. Okay, students. I hope this is clear. Then I think there is some question, risk premium when invested in market securities than in risk-free security. Uh, so Tanisha, maybe you're telling for this risk premium when invested in market security than in risk security. So what I'm trying to say is that this is already a premium, okay, for that respective factor. We cannot say that it is a market security related premium. Okay, perfect. Let's spend another 10 minutes in just wrapping up our entire discussion because I think mostly the concepts we have done and whatever was part and parcel of the questions also, that also has been covered. So let us just have a quick revision on the entire thing that we have studied till now. Okay, students. Again, I'm asking in case any other question is related, unanswered, or you have any other query in your mind, please do post it. We will take it up for that answer. So, students, we have started our discussion on portfolio management, and we said that first of all, we have to do the security, right? So in security, we said that return and risk are the two biggest, factors which we have to keep in mind. For return, we said there are two ways to calculate historical and futuristic, which is in case of probabilities. For risk, we said that from our previous knowledge that it is a standard deviation. And here the point to be noted is actually whenever, or let's say I'll just simplify this, we always need to always take variance while doing additions or subtractions. Reason being, if you directly take standard deviation and add or less, then it will be wrong. Correct? We have discussed in a lot of questions that we have to always take variance. Let's say systematic plus unsystematic is total variance, and then it will arrive at the total risk. Otherwise, total risk minus systematic will be unsystematic, but that all calculation will happen at a variance level. Okay, students. Then we said that risk is actually an outcome of two two major factors. One is macro and second is micro. Macro factors are those which are related to the system, and hence these are called as systematic related factors. However, unsystematic factors are those which are specific to a business. So the overall macro factors are interest rates, which is related to the economy, market trend, and purchasing power, which is inflation. Similarly, unsystematic, or let's say specific risks are business risks, which is that tomorrow, if let's say the industry in which that company is operating faces a major, let's say raw material, packing material shortages, or the customer, they changes their preferences. They are not taking those products now anymore. So those will be there and liquidity risks. Okay. Then comes, so this we understood more from calculating the, beta as well as R, which is correlation coefficient, and even variance and covariance for that matter. But I hope with all this discussion now it is clear that what is the difference between variance and covariance. So covariance is actually the collective or the joint variance of two series, and variance is actually the variance within the single series. Okay. This we also understood for historical and futuristic data. Correlation coefficient, students, we have discussed that it will range from -1 to 0 to 1. Reason being, it cannot be more than 1 and it cannot be less than -1. And it tells you the degree of association. Correlation coefficient tells us the degree of association. What is the degree of association, students? Okay. And the way to calculate it is covariance between x and y divided by standard deviation of x and standard deviation of y. Okay. Here we also discussed about coefficient of determination, which was actually r square. Okay, students, coefficient of determination was r square, correct? That's what we discussed in one of the question. And hence, if in question you have been given a coefficient of determination and you have to arrive at the correlation coefficient or coefficient of correlation, then you will just take a square root of this. Okay. Understood, students? I hope we are able to recap whatever we have studied earlier. Then came the portfolio return and portfolio risk. For portfolio return, we said that we will just take the weighted averages of the individual securities to arrive at the portfolio return. It is very easy. Whether it is a Sharpe's index model or Markowitz portfolio theory, the respective weights are to be used. For risks, for portfolio risk, we said that under Markowitz portfolio theory, since we are going ahead with the concept of R, concept of security variability with another security. Hence, we were supposed to calculate the portfolio risk basis these formulas, which uses R or covariance, right? Similarly, for more than two securities, we said that we can adopt this simple matrix approach. And I'm just clarifying, even this matrix approach can be applied for two securities also. Okay, there is no issue in that. It can be applied for two securities also. The result will be similar. Sorry. Sorry. Then this is also very important formula to remember, students, that for calculating a return, sorry, for calculating a return, we need to also understand, apart from dividend and closing price, we have to divide it by the opening price and minus opening price. Sorry, students, I actually did a mistake in this formula. It should not be -1 because we have already reduced opening price from here. Okay. So please note this correction here. It should not be -1 because opening price is already reduced. Then comes the then comes the discussion on beta. We said that total risk was systematic and unsystematic. Please do remember, beta is not systematic risk. This is very, very important. It is a measure that helps in calculating systematic risk, but it is not at all a systematic risk. So X limited in relation to market and beta is calculated using these two techniques, students. Okay. Then let me quickly jump on to the discussion that we had on, wait, on the securities market line and capital market line. Just a second, students. With that, we will cover our Sharpe's and Trenner's ratio also. Yes, this one. So finally, we said that in these two concepts, capital market line and securities market line, where we said that capital market line, the base is always standard deviation, and securities market line, the base is always beta. And hence, within the line itself, we can say that the slope of this line is actually the Sharpe's ratio, correct, of market. And similarly, slope of securities market line is the Trenner's ratio of market. Both the ratios are very useful in analyzing or evaluating a portfolio, students. And we have also seen that Trenner's ratio is used in the Sharp's optimal portfolio? The question that we did today to arrive at the optimal portfolio, students. Okay. Then nothing else, I think. The last part also we discussed today, which is on the arbitrage pricing theory. I think that covers mostly the questions as well as conceptual part of it. Students, again, I'm asking if there are any other questions, please do let us know. We are there to answer on the portfolio management. Otherwise, I request C. Ashish sir, who is there with us, to conclude the session. And yeah, thank you, sir. And thank you.
Thank you, Devas, for your wonderful session. I think I have one question to discuss with the student.
Sure, sir.
Okay, so you can stop sharing,
Sure,
and
sir.
if possible, then you can also leave. No problem.
Sure, sir. Thank you, sir.
Thank
Thank
you. Thank you. Okay, student. I hope the session that till covered has Devas sir covered this topic of portfolio management in a very great manner, a very excellent manner. Student, while I was going through assignment, there was one question. Basically, this question is relating to your portfolio strategy, but however, this question is normally covered in your mutual fund topic. So I thought, okay, I can share this question at this moment. Okay, there is a basically called constant ratio or constant mix plan. There are three strategies like buy and hold strategy, constant portfolio performance, constant proportion portfolio insurance, and then there is a strategy called a constant mix plan. Okay, now accordingly, what I want to say, I want to discuss one question so that this strategy also it is a part of basically portfolio. However, it is the top same question is covered in mutual fund. So I thought ki I can cover this moment. So please hold for second. Then this is a question is from your study material. You can do refer from there. However, I am solving here for your reference. Okay, student. Let us see the question. नहीं सेशन में दे रहा हूँ. I am continuing. Now, student, on your screen, there is a question is basically this question is from the mutual fund. So just read this question. Okay, then I discuss with you the solution of the same. Student, please note that this question is very quite simple. Just have some attention, then you will find that there is will be no problem. Okay, just read the question. The question says like that. Sunidhi is working with an MNC at Mumbai. She is well versed with the portfolio management technique and wants to test one of the technique on equity fund and that she has constructed and the compare the gain and losses technique from the technique with those of passive buy and hold strategy. Okay, passive strategy means you just hold and buy the share and hold it for a long time. This is called passive. The funds consist of equity only and ending NAV of the different constructed for the last 10 months are given to the student. The NAV basically net asset value Net asset value means basically this value belongs to you can say uh, market value of the securities held by a fund minus liabilities. Okay, this is called net asset value. Okay, when we divide it by number of securities, number of units, not unit is units, we call NAV per unit. Okay, clear, student. Now, so just to consider it as a kind of a market value of a share, we can say like that. Even we can make a parity with the market price of the share. Now it says like that: December ending value 40, 25, 36, 32, 38. This is March. This is March, April, May, June, July, and August. So this September till they have. Now Srinidhi has invested a notional amount. Now he is just trying to see how will he can she can make the what will we have gain or loss. Okay, 2 lakh equity equally in the equity fund. That means equity market. You can say it is kind of a equity market. Okay, and conservative portfolio. You can say it is kind of a uh, risk-free securities, government securities. Okay, where that there is no risk or bonds. In the beginning of the December 2008, and the total portfolio was being rebalanced each time NAV of the fund is increased or decreased by 15%. Now, student, please note that this 15% is very important because if there is an increase or decrease of by 2, 5, 50, less than 15%, it will be no movement. It can be increased or it can be decreased. Okay, so student, please pay attention. Then I discuss. Let me have some. Let me see whether we have any query. Then I will just 1 second. 1 second, students. Okay. Now let us start solving the question. Okay, friend. Now I am writing here NAV. Okay. Now, students, see here what we are doing. It says we have to see she has invested. She has 2 lakh invest 2 lakh rupees of amount. Okay, and she wants to invest equally in equity fund and conservative portfolio. Okay, so it means 2 lakh will be divided into 1 lakh will be divided into bond portfolio and 1 lakh will be invested in equity portfolio. Please note, bond portfolio will not be affected by any market change. Okay, Mansha is asking, sir. Yeah, passive portfolio means you are holding for a long period. Yes, you are right. Okay, my too low. My voice is too low. Students are right. Now I think student, my voice will be clear. Just let me know. Okay, I think it will be clear now. Okay, student. 1 second. I just report. So 1 lakh will be invested in equity. Please note, this value may be go and up and down. Okay. So now today NAV of the she is investing in the beginning of 2008. Okay. Here NAV is 40. Okay. So number of units will be 1 lakh divided by 40. It means 2500 units of equity funds. Okay, it can also be considered like shares. Okay, no problem. This question can also be solved on the basis of share price also. Here, this amount will be changed proportionately because since we have not been given any amount, now we shall see how we operate the strategy. Okay, first NAV is 40. Okay, our value, we shall invest 1 lakh in bond. We can write it as a conservative, not my mistake here. Please write it as a conservative. Mistaken. Bond portfolio. I'm just writing here bond or conservative portfolio. Okay, not passive exactly. Okay, here 1 lakh I am investing in the equity. Okay, so total my amount is 2 lakh. Okay, no action is needed. Number of unit is 2500. Now my price falls to 15, 25. Okay, my price falls to 25. Now see here, question comes whether I take the action or not. Now question comes, it says the price should be decreased or increased by 15%. Here please student note that 40 minus 25 divided by 40 into 100. Okay, so how much is the change in the price? Whether it can be increased or decreased, divided by 40. It is coming 37.50. It is coming at 37.50. So it means we have to take the action because it is crossing the benchmark or it is crossing the limit of 15%. Now let us see what we have to do. See, value of bond portfolio will not change with a change in price. However, 2500 units are there. Their price has come. 1 second. Their price has come 25 2500 units are there. So the amount come 62,500. Okay. So the equity value will be this much, 1,62,500. Okay. Now what happens? It says rebalancing. It says rebalancing. It means how we carry out the rebalancing. Let us see. Rebalancing means, see, our target was to make the 50-50% equally amount. So what we do, we invest, we divide this amount equally into the both portfolios. Okay. Accordingly, 162 500 divided by 2, it comes 81 250. Okay, because we have to invest, allocate the equal amount in the both the shares. Okay, both the funds, passive, conservative fund and equity fund. Okay, now this balance comes one to this. Now what happens, since our amount is needed 81 250, however we are holding only 62 500. So what we do, we need to buy the units. So how we buy the units, let us see. First of all, 81 250 we need. Okay, and how much we are holding, we are holding only 62 500. So this much of additional amount is required. This much of additional amount is required in equity. So what we do, we sell bond fund. Bond fund is 100, we minus 18750. Okay, so balance will be left 81 250. So this amount will be come from the bond fund or conservative fund. Okay, by 750 units. Okay, now question comes, how we compute the 750 units. Let us see how we have computed the 750 units. We have to invest 18,750. Okay, we have to invest 18,750. So, and the current market price is 25. So we buy 750 units. Okay, how we increase this our portfolio value by 18,750. So we buy it by purchasing units at a 25 per unit rate. Okay, buy to 750 units. Okay, so total number of units comes 3250. Okay, student. Now we come to price 36. Now we come to price 36. Now here my bond value will remain the same. Okay. Now what happens? My units are 3250. I multiply this with this. Okay. The value comes 1,17,000. Just multiply it. Okay. The total portfolio value comes. Now question comes whether I need any action of rebalancing or not. Yes, I need. Why? Because see here, my price variation is from 25 to 36. How much it is? 36 minus 25 divided by 25. It is 44%. Okay, my benchmark is 15%. So of course I will do rebalancing. Now how will I rebalancing? As usual, I will divide this into two parts, 198. So the amount come 99 125. True. Now what happens? Total comes 98 250. Okay, now student, please see here. Now what I have to do now? I am holding this much of amount. I have to reduce the value to this. So I will do the sell action. I will do the sell action. Earlier I was doing the buying action. Now I will do now sell action. So how I will do? 1,17,000. Okay, minus 99 125. I need this much of amount. Okay, so how much worth of security I will sell? 17,875 security amount of rupees security I will sell. Okay, when I will sell, so what is my price? My price is 40. Sorry, my price is 36. Okay, so I will sell 496 unit, 3353 units approximate to rebalance my portfolio. Okay, so what I do? 99 125, 99 125, 198. Sorry, I'm just writing it again. It is already written here. Okay, so 1 second, I just erase it. Okay, now I sell 496.53 units. Clear? So the balance unit will be left 270 2753.47. Okay, now again I come to next price 32. Okay, now 32, my value of conservative portfolio will remain the same. However, I will multiply 32 with this 32, with this price 275 2753.47 into 32. Okay, so the value comes 88. Okay, so this value plus this value, it becomes 187, 236.04. Now question rises whether any action is needed. See, here the price changes 36 minus 32 divided by 36. It means it is coming 11.1111%. So it says whether any action is needed. No, there will be no action will be needed because the price has not changed by more than or up to 15, 15 or more than percent. So we are not taking any action because of this 11%. Now next it says 38. So 99 125. So total comes. Okay, student. Now it says whether any, let me check whether any action is needed. 38 minus 32 divided by 32. Now it is coming 18.75%. Yes, I need a action. I need a action. Okay, so now I divide this amount into two parts. The amount comes there. Now, as usual, I see there is a reduction in the investment. So I sell the units by the difference amount. Okay. Now I come to price is 37. Here I multiply with these units. The bond value will remain the same. Okay. Now here no action is needed because change is very less. Okay, no action is needed. Similarly, if I go further, now price is 42. If we multiply this unit with this price, the amount comes. Okay. Now this increase also is very less. We shall not do any rebalancing. Okay, students. So we also do like that for 50. Here we shall see the change. 50 minus 43. One second. 50 minus 43 divided by 43. So it is coming more than 15%. Yes, action shall be required. Let us see what action we shall take. We can continue the it. Like, just a second. Just a second. 235,928.94.93. Okay. Now here we do we divide this amount into two parts. 117,964.50 is somewhere around. Let me check. 235,928.93 divided by 2. Sorry, it's somewhere around coming 47. Okay. Sorry. Okay, student. Now the difference amount this much, 134.50. So we sell 321.72 units. Okay, so balance will be 235929 units. Okay, student. I hope it is clear to you. I am coming to the last price, 52. Okay, now here we shall see the change. So it is no action is needed because in change is very least. Okay, student. So I hope you have got clear this question, how the portfolio rebalancing strategy works, or how the strategy of constant proportion portfolio not proportion portfolio insurance, that will be covered in the derivative, but that has been covered earlier. So you have to see how we can how we follow the strategy. Okay, with this, student, we come to the end of today's session, and I hope Divas sir has covered almost all topics of the portfolio management. Of course, if you have any query, please you can contact us 030 45956. Okay, or you can send your queries at a mobile app. As I told you, within 1 or 2 days, we will clear all the previous our mobile app. So, student, please revise whatever have been discussed in today, the last two classes or in today's class are about the portfolio management. One more important thing, students, we have tried to cover as much as questions are possible. My advice to you, please don't ignore ICAI study material. Okay, assignments are in no way are the replacement of the study material. So you have to be very thorough with the study material and whatever way ICAI publication that is currently hosted on ICAI website. Okay, so don't leave any publication ICAI untouched. You have to do each and everything. Okay, student. I think there are no more queries. So with this, I end the session. Thanks, patience. Thanks. I thank you all for patience listening, and see you in the next class on the new topic. Thanks a lot. Have a nice day.